Good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative. This is the last week in Mortgage Today. Seeing a lot of you still getting logged on. We'll give everybody another 30 seconds or so, and then we'll go ahead and get started.
How are you feeling, Rich?
Feeling good. Yeah. I'd be feeling a little better if my Indians didn't get shut out in the home opener yesterday. It felt great to be at a baseball game though, outside. Like I was reveling.
You went to the game?
I went to the game. Yeah.
Oh, cool.
Yeah, they allowed like 11,000 fans in there, and it was good. Nice weather. We lost, but that's one of the things I've missed more than anything these last 14, 15 months is live sports.
Right. Yeah, that's from a sports standpoint, even just getting along, just seeing people socially and in groups. I miss people coming to the office, but that's the way it is for now. And I'm looking forward to the conference in September.
Oh, I was at that property last week. It is ridiculous, to put it lightly. It's going to be a great event. So,
wow, that's awesome.
All right. Good afternoon, everyone. This is Rich Swerbinski with the Mortgage Collaborative. This is the last week in Mortgage Today, our weekly walk through all the latest, greatest news and happenings in the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, very pleased to be joined by my friend, one of our oldest members, one of our board members, the best dressed man in the mortgage industry, founder and CEO of U.S. Mortgage Corp, Stephen A. Milner. Stephen A., thanks for joining me, bud.
Thank you, bud. You're the best, Rich. But before we go on, I just want to say that on behalf of the Mortgage Collaborative, as the president and CEO, I just think you're doing an outstanding job day in and day out. And we've all had our challenges running our organizations, and I think you and your staff have done an outstanding job. And I want to commend you and thank you for all that you've done for the members and the industry itself. So I wanted to lead the discussion off by saying that, sir.
Thank you. That means a lot coming from you. And I remember, like, you were one of the people. I remember meeting you at the MBA secondary conference in your hometown in New York. And we were just getting going and, needed credible members to join, and asked you to kind of take a chance on what we were doing. And I'm glad that you found value in it. And appreciate your membership.
Thank you.
Right. All right. So let's get into it. So much going on right now in the mortgage industry. It's crazy right now. We're coming off this insane year of volume and margins. Volume has slowed down a little bit right now, but just so much going on right now with just a burgeoning inventory issue in the industry, escalating home values. We're coming out of the pandemic. We've got a new presidential administration that's putting some housing policy proposals out there, changes at Fannie, Freddie, HUD. To start out, though, Stephen A., how did 2020 end for you? And what are some of the major initiatives you guys have in the hopper right now as we get into Q2 of 2021?
Well, 2020 was a great year. We close to 1.8 billion. We're very excited about that and very proud about that on the volume side. As far as initiatives, Richard, we're really focusing a lot on expanding our training and on a training department, not only on the ops side, but more on the sales side. As you know, before I got into the mortgage banking business, I was a teacher for 18 years. So I've always been very focused on education and teaching, even to this day. So I embrace that. But we're doing a lot on the, we're a purchase money shop. We're still doing about 72% purchase money. So we still continue to pursue that. And as you know, I still originate loans, 8 to 10 million a month myself as the CEO. I'm licensed in every state. So I embrace that, and my salespeople seem to like it because it really keeps me in touch with the manufacturing process and the assembly line. And I'm very much focused on that.
Excellent. And yeah, such a throwback CEO, still originating. I know every TMC conference, you'll see Stephen A. usually in the front row of every session,
Correct.
studiously taking notes. Yeah, a guy that works hard, and I know you love to keep learning.
Yes.
27 years now, I think you've had the company, but you're always trying to figure out what's going on, what's going to be happening next in the industry.
Well, I think we have to, I mean, which topic you want to start with? I mean, as far as housing prices, I think prices are still escalating everywhere due to lack of inventory. Medium home prices, I don't know, what are they approaching? 350, 340, something like that?
I think I saw, yeah, the median list price on a home, I think it was in February, which, homes just keep going up in value through March, and now into April was 346, which was up, I think, 17% year over year. I mean, that's a little, does that give you any pause, any concern as the CEO of an independent mortgage bank that home values are escalating so quickly? There's could be good to that, right? Providing equity for people that,
Yeah.
but
Yeah, I'm not, those things really don't concern me too much, because I've been in the business 41 years now. I started in 1980, and I've seen every cycle there is as far as home buyers that, borrowers desire to fulfill the dream of home ownership. And I was originating loans at 21% on a fixed rate in 1980. New York City was going bankrupt, and people were still buying houses, so they still pursue the dream of home ownership. And yeah, okay, so we have a shortage of inventory. I learned the other day that we have more real estate agents now than homes for sale. That's an interesting statistic, but that's the reality. And I think people will continue to look, and all right, inventory is down, but I don't think that'll stop people from pursuing purchasing a home. And I think we'll get past it, and building is going to continue. There's going to be more permits out there than we've ever seen before. So I'm kind of excited about it. It's another wave that we have to ride, so to speak. And I think we'll do fine. So I'm not really that concerned about it. The purchase money business has always been the lifeblood of the mortgage banking business, and it will continue to be so. Refinances are great, but purchase money is what keeps companies in business, in my opinion.
Without a doubt. And I know you guys have always been a very purchase-focused shop. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by the founder and CEO of U.S. Mortgage Corp, Stephen A. Milner. As always, we strive for an interactive program. Any questions, comments, anything to add to the show, please feel free to drop it in the chat or the Q&A. I already see a couple notes in there confirming Stephen A. is the best dressed man in the mortgage industry.
Stop.
Also, a couple from some of our Michigan members giving me a hard time about the Motor City Kitties, the Detroit Tigers taking 2 of 3 from my teams to start the season. So, but Stephen A., what about, so we have a new presidential administration,
right.
And there was a lot, as all presidential candidates have housing policy that they have out there on their website as part of their official platform. Was little to no talk about the housing industry in any of the pre-election debates or run-up, but we've seen President Biden be pretty aggressive as it relates to potential things that could be coming down the pike. Just released a large infrastructure plan that had a lot of housing tentacles to it,
Right.
calling for the construction or rehabilitation of, I think it was like 500,000 homes in low and middle income areas. He called on Congress to eliminate some of the zoning laws that are penal to home builders, that's restricting some of the things they can do. Just curious as to your thoughts on, just as it relates to housing policy, the new administration, government's role in mortgage lending, and, some of the things that you've found interesting or notable about the new administration's housing goals and plans.
Well, it's a good topic for discussion, Richard. And I just feel that, I embrace the Biden's administration for expanding their infrastructure plan as it relates to construction and rehabilitation of homes in low to moderate areas. Just philosophically, and I've always felt that everyone is entitled to a roof over their head, but not everyone is entitled to a mortgage. So as IMBs, we have to be careful about that. And I feel that if we had that philosophy in the late 90s, early 2000s, we would have avoided the Great Recession, quite frankly. So as much as we want to implement plans for low to moderate income homeowners, they still have to demonstrate the ability and the willingness to repay their loan. So we have to be careful about that. There's a balance there, and making good quality loans, respecting the relationships that IMBs have with their partners, whether it be the agencies or the aggregators, is a top priority. And I always say it's not about doing right. It's not about being right. It's about doing right. So we have to follow that philosophy going forward. And I hope that the Biden administration does not get that involved in the day-to-day routine that a mortgage banker has to go through to ensure that the loan performs. At the end of the day, the loan has to make sense. And if it doesn't make sense, it doesn't make dollars. It's as far as I'm concerned.
You're right, because it's a slippery slope, right? I mean, everybody wants people to own homes and build wealth through a home, but there can be too high of a home ownership rate in America. And we saw that really lead to the mortgage meltdown in 08 and 09. Both really the Clinton and Bush administrations contributed to that. And we got to the point where we just had people with mortgages that, I tell the story all the time about my one buddy, Joe, that, my degenerate buddy growing up, like when he got approved for a mortgage, I knew something was wrong with the system. And so it is a slippery slope. And but I think you're going to see the Biden administration has been very vocal about low to moderate income buyers and kind of leveling the playing field for them. And be interesting to see what happens there. On the flip side, though, we've been talking on this show and other shows we've done here on TMC Connect about some of the changes coming down the pike from Fannie and Freddie. Fannie knocked the first domino down by announcing restrictions on investment properties and second homes. It really, escalated and magnified some of the other changes likely to be coming down the pike. Your thoughts on the GSEs, their role as part of our housing finance system in America, and what you, just as a business owner, would like to see happen with Fannie and Freddie, as we get into 21 and 22 here?
Interesting question. So as you know, the agencies, Fannie and Freddie specifically, have been under conservatorships now since 2008. What's that, 13 years? Mm-hmm. So, and I know there's been a movement over the years to try to privatize GSEs, but I don't believe it's going to happen now. But I think we have to remember, if you will, that in 1938, government established Fannie Mae. 1970, they created Freddie Mac. Their purpose, the reason they were created was to provide home ownership financing, and that's been very successful. It was never really intended to provide financing. And I'm an IMB speaking about, how the 7% cap is going to impact our business. It was never really intended to provide financing for investment properties or second homes, and I think people tend to forget that. And I think that's the direction we're going back in, as proposed by the FHA, to be quite frank. And I guess it's just going to, it's going to affect our business to some degree, but at the end of the day, owner-occupied primary residences is what will drive the industry. Yes, we'll have some economic impact to some IMBs who focus a lot on second homes and investment properties, especially cash outs, which are really going to go. The pricing is really going to escalate through the roof. But it is what it is, and we'll have to deal with that. But I think that's why FHFA is doing that, because they're not gonna move towards privatization, and this is one way in which to secure their economic stability, if you will, in my opinion. What I am more concerned about is the cap that they may put on of 6%. I think there's a proposal. And as you know, I'm very involved with the MBA. I was the president of the New York MBA, and I'm on the Independent Mortgage Bankers Executive Council. And there's so much talk about the 6% cap on purchase loans, and I think a 3% cap, if you will, on refinances. When 2 or 3 conditions are met, if the loan to value is greater than 90% and the borrower's DTI is above 45%, I think that excuse me, will have a major impact on our business and on housing in general. So we have to sort of balance that, and so we have to be careful regarding those points. I'm more interested in that, quite frankly, than the 7% cap on investment in second homes.
Yeah, I think it was FICO under 680, CLTV over 90, and
Right.
back end ratio of over 45.
Yeah, those 3 factors above that. Yeah.
Loans with 2 of those 3 characteristics would be capped. 3% of total loan sales on refinances, 6% on purchase. And yeah, I do know MBA is looking into that. Any insight there? I know you are very involved with MBA. They're got to be leaning hard on FHFA to be gentle there because of the impact you noted.
Yeah, no, and we talk about it I'm on every conference call every week. CNPB, we have a conference call every week, talking about it, with Pete Mills, and he's doing a great job with the MBA on that end. And that concerns me probably at this point more than anything right now. GSEs have to survive. We get it, right? I don't think they're going to privatize, but so that's what they're doing. Fail to plan, you plan to fail, right? So that's what I think they're doing going forward.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by Stephen A. Milner, the founder and CEO of U.S. Mortgage Corp. And Stephen A., to your point, the agency is kind of putting themselves likely not headed for coming out of conservatorship, but doing some things to get their house in order for whatever lies next for them. What about repurchases? Is that something that keeps you awake at night? Maybe that we may see a clamp down there, loans that you sell to the agencies that are going through, post-funding QC reviews by Fannie and Freddie. What are your thoughts on that topic?
That's interesting. You raised that issue, Richard. I am kind of concerned about that because, the industry did so much business last year that I don't believe QC was probably done at the point of sale. I'm sorry, at the point of purchase by either the agencies or the aggregators. And now the business is slowing down. I think they're having a lot more time to quality control more and more files. We sell directly to Fannie and Freddie, and we're getting more and more inquiries. And I think that's a major concern that IMB should have going forward. Whether you sell directly to the agencies or you sell to the aggregators, ultimately it'll come back to you, right? So I just think that may be something we really have to keep an eye on, because I think, with all the business that the aggregators purchase, again, to ensure their economic stability, they're going to want to make sure that the loans are going to perform. And if they can push back to the seller, the originator, they're going to do that more aggressively than we've seen in the past. Only because a lot of the loans were purchased without any really major quality control prior to the sale. So I think we're going to see that. And, I would, as far as what we do at U.S. Mortgage, we try to do a great deal of pre-closing QC, even though the limit is 10% post-closing. But, if I could, I would try to do QC on every single loan. It's not possible. It's very hard to meet closing dates to do that practically, but we try to do as much as we can. And you'd be surprised when you do that, when you're aggressive, some of the things that you find. People will make mistakes. Underwriters will make mistakes. That's just the way the business is. So you have to try to protect yourself because it will come back to you if you miss some things. And I think the agencies will find the time. They certainly will have the ability and the willingness to push back. So I think that's something we should be concerned about going forward.
Yeah, I've heard the same from other members of ours over the course of the last few weeks as volume has died down, that they've seen more inquiries from the agencies, just on QC related things. And your point is valid. It was just so much volume that was pumped through the system last year. People were working so hard, so many hours, you know it better than anyone, underwriters and working weekends and it would not stop. The volume would not stop. And overall, we have a much more compliant industry than I've ever seen in my time in the industry. But just the volume related, errors or oversight, that lack of oversight that could have existed, that I know a lot of our members are kind of doing their own above and beyond QC. Maybe they did, 10% pre-close and 10% post-close QC last year as the loans were coming through, and now they're pulling bigger sample sizes to see if they can find anything under the sheets that maybe we're digging deeper into.
Yeah, I think so. I think we're going to see that, and I think we should all be concerned about that.
We also had new HUD Secretary Marcia Fudge
Right.
came out a couple of days ago and said, "Hey, we're not going to be reducing the FHA insurance premium." There had been some speculation, that could be something we'd see. It's something that MBA, has talked about in the past. And, I think her point was, we still have a little bit too much delinquency, a lot of it related to forbearance and the pandemic, and now is not the right time. Any reaction to that news?
Well, they're pretty, the fund is pretty solvent right now, and I would personally like to see a reduction either in the upfront or the monthly, but I don't think it's going to happen for now. And they want to try to maintain their solvency. So I don't think it's going to really impact government loans that much. We do a good percentage of, government FHA loans, I should say, so I don't think it's going to have much of an impact. I would like to see it. It would be great for the consumer.
Mm-hmm.
But
and as you noted, the insurance fund is well above the required capital levels. That's what led to a lot of the speculation that you could see a reduction. But, what about your thoughts on, what we were talking about just a little bit ago, some of the changes, that were in the Fannie Freddie preferred stock purchase agreement amendment related to loan characteristics. You mentioned it before, no more than 3% of refi loans and 6% of purchase loans sold to the agencies can have characteristics of under 680, over 45, or
over 90
combined loan to value. So my thought on that was that, like, already in our industry, that 5% down 670 borrower, at least when I was still, working for an originator, in most cases, that because of the FHA insurance premium, the side by side on that borrower, a conventional Fannie Freddie loan versus an FHA loan, the better deal for the borrower is the agency conventional loan. In most cases, was my experience. The more profitable loan for a mortgage lender is the FHA loan. So I was pontificating aloud about this topic on this show last week. That I think you'll see a lot of lenders do the right thing and put the borrow in the best option for them. But this could steer a lot more lenders towards FHA loans, putting borrowers in those FHA loans in that scenario, which could adversely select FHA, could potentially negatively impact FHA a little bit and see them get some additional volume. But any thoughts on
maybe that's a good point. Maybe that's what they're what's her name, Marcia Fudge. Yeah. Maybe that's what she's thinking as well. But we'll have to watch that. I don't, as far as my company is concerned, I don't think our loan officers think that way. Comp is not a function of that since April 11th, 2011, when when Dodd-Frank Act changed the LO comp rules, where you can't get paid on the terms and conditions of the loan. And I don't see the salespeople in my organization thinking that way. We certainly don't pay that way. So I don't think it's going to have, it's not going to create, I think our salespeople will, and depending on the sales leadership, will continue to provide the best financing choices for the borrower, whether it be government loan or, or a conventional loan through the GSEs. And even the bond loans, we're very active in the bond loans, even though they present compensation issues, which we know about, but sometimes that's the best solution as well.
Absolutely. This is the last week in Mortgage Today. I've got 4 or 5 minutes left with U.S. Mortgage Corp. Founder and CEO, Stephen A. Milner. I've got a couple of questions and comments in the chat, and would encourage anybody who has any questions for Stephen or I, or notes, feel free to go ahead and leave those in the chat or the Q&A. One of the questions, any thoughts on the possibility of the 3D printed home to help spur the low to moderate income buyer? Appears to be a possible solution to a long lingering problem. Stephen A., have you followed any of this 3D printed home thing? I've seen just a little bit of it, but these 3D printers are now starting to create some homes, and there's some thinking that this could be something that will become more prevalent in the coming years.
Yeah, I've read a little bit about it, but it may be a source for additional, additional, I guess, inventory, if that's what you're referring to, right?
Mm-hmm.
But again, going back to my original point, it's still, at the end of the day, it's about ability and willingness to repay the loan, and we must stay focused on that. Just because a borrower falls into a low and moderate income, I understand that, and I appreciate that, but they still must be able to demonstrate the ability and the willingness to repay the loan in a timely manner. Now, that may create more activity, I understand it, more inventory, but at the end of the day, we have to work together with our partners, whether it be the GSEs or our aggregators.
Cool. And yeah, it wouldn't be an episode of the Last Week in Mortgage Today without some sort of comment or joke about the whole Rocket Mortgage. Have you been following this, Stephen A., the Michigan rivalry, Rocket Mortgage?
Yeah.
What's your thoughts? I always like to get the thoughts of our IMB CEOs, these big prominent independent mortgage banks that are, 1 and 2 in market share in America now. What are your thoughts on that?
I just don't see the reason for that. I just have a basic philosophy of life. Again, it's not about being right. It's about doing right. And I don't think the message from United was the right thing to do. And I don't have any problem defending that. You gotta really be very careful about some of the things that you do and the positions that you take. The brokers have been, this is a freedom of choice. They should be able to go where they want to go. Simple as that, and not should be penalized if they're selling loans to Quicken or someone else in this case, or Fairway was the other one, right? So
Fairway, yep, mm-hmm, yep.
Yeah. Rocket, I meant, instead of Quicken, right?
Rocket, Quicken, whatever they're going by now, yeah. So, and then the last question we had come in, Stephen A., your thoughts on the new iteration of the CFPB? Are you making any changes internally at U.S. Mortgage Corp to help prepare for a more aggressive compliance environment?
Yes, that's a very good question. I think that, we are, as I indicated before, we are really expanding our training department so that more and more loan officers, and we're very aggressive on hiring newbies, so to speak, new loan officers, which is a separate discussion I can go into, but we're doing a lot more on the pre-closing QC, not only from an underwriting and processing standpoint, but from a regulatory standpoint. It's not just getting the loan closed and shipped and funded. It's about closing that loan compliantly. And one of the things most mortgage companies have issues with is probably tolerance cures because loans weren't disclosed properly. So, and that's costly. It's not only costly, but it's not compliant. So, you have to be careful of that. You have to be concerned about that. And I think the CFPB is really, with the new administration, is going to be really all over us, to be quite frank. And that's what they were established for. You know, they have to protect, they have to avoid what occurred starting in 2006 all the way through 2010. They have a responsibility. So, you know, and compliance should not affect production. That's the bottom line. We should all be a culture of compliance, in my opinion. And that's what
technology makes it easier, right? I mean, you know, there's some of the technology that we have available right now as mortgage lenders. It makes compliance easier. There is more automated compliance, and it does help with that, no?
Yeah, it does. But files are still touched by Homo sapiens, as I call them. You know, we all are, and people will make mistakes. That's just the way it is. You can't avoid it.
Excellent. Stephen A., thank you so much for joining me. Always
thank you,
enjoy talking about the mortgage business with you, my friend.
Yeah, and thank you for doing such a great job, as I said at the beginning. You know, as the president and chief operating officer, you really, every session I walk away with a nugget, as I call it.
Nuggets, the nuggets. We've reused that and many other Milnerisms over the years. Just in the way we
Milnerisms, yes.
If you are not friends with Stephen A. On LinkedIn, you got to immediately send him a friend request, because he does a great job pumping the Milnerisms into his timeline. Really a lot of wise words to live by from a guy that's been doing it and doing it right in this industry for nearly 3 decades. So
thank you so much, sir.
We appreciate you, and to all of our attendees, thank you very much for taking some time out with us. We are here every Tuesday at 2 p.m. Eastern for the Last Week in Mortgage Today. Also turn this into a podcast and release this to our YouTube channel, where I know a lot of you watch it or listen to it as well.
Great.
So, all right. Until next week.
You're the best.
We'll see you then. And thanks again, Stephen A.
Thank you, everyone. Thank you, Richard. You're the best.
Take care. Have a great afternoon, everyone.
Bye-bye.